What's up, traders? Welcome back to another episode of Investeen hosted by me, Rishi. As you can see, I got some merch that I'm going to start wearing for the rest of these videos. But apart from that, we have covered the first 6 letters of CANSLIM, and we're now moving into the last one, and that's M, and it stands for market direction. And the reason why this is one of the most important letters and aspects of CANSLIM is because the performance of a stock depends on the performance of the underlying market. Let's get into the video. During market downturns, 75% of stocks, on average, will sync with market averages. And even if it meets all other criteria of CANSLIM, a chosen stock is not very likely to be the one to completely outperform the market and move separately from the rest. On the other hand, 3 of 4 stocks tend to move upward alongside the general market during bull markets with strong upward price action. And when I refer to the general market, I'm just talking about the major indices that tell us about the strength of each day's trading activity, right? And these indices include the S&P 500, the Nasdaq Composite, the Dow Jones Industrial Average, and the NYSE Composite. And for background, the S&P 500 consists of 500 of the largest public companies in the United States, giving us a great overall view of the market performance. The Nasdaq Composite is weighted to give us more focus on the tech sector, containing companies that are younger and more innovative. The Dow Jones Industrial Average consists of 30 large cap equities with a primary focus in cyclical and industrial stocks compared to the other indices. And finally, the NYSE Composite comprises of all common stocks listed across the New York Stock Exchange, weighted on the stock's market value. When looking at these indices, we can analyze the trend in both the short term and the long term. For the short term, we want to be seeing if these indices or even leading stocks are above their 20-day or 30-day moving averages with strong upward movement on high buying volume. And for the long term, consulting moving averages like the 100-day or 200-day moving average would be better. I also want to bring back a previous topic that I discussed in my top-down approach series. And so understanding the business cycle is super crucial for any winning investor, as the stock market serves as a leading indicator of economic conditions. Unlike lagging or coincident indicators, the market anticipates economic, political, and even global events months in advance. So just relying on economic indicators to make investment decisions is really misguided, as the market often makes its moves before these indicators reflect the underlying economic conditions. So if that felt like a lot of information, just look at the diagram that I do have on the screen right now. And all it's showing is that the stock market, which is in green, is acting before the economy, which is in purple. And that's all you should know about what I was just saying. Okay, so now I want to move to the idea of stage analysis. And it offers a more nuanced, I would say, approach to navigating market cycles by identifying the distinct phases within both bull and bear markets. So markets move through 4 primary stages, which are accumulation, markup, distribution, and markdown. And by the way, markup and markdown are the same thing as uptrend and downtrend. Each stage is characterized by specific price behaviors and investor sentiment, with the accumulation stage marking the end of a bear market as investors begin buying undervalued assets. The markup stage sees rising prices and increasing participation from investors, and the distribution stage signals the market's peak as sellers begin outnumbering buyers. We're going to mention distribution again in the rest of the video, so make sure you caught that. Finally, the markdown stage reflects the decline as market corrects and resets for the next cycle. As O'Neill mentioned countless times, the best way to understand something is by analyzing the subject at hand. Knowing how to read the market comes from practicing analyzing leading stocks, indices, and keeping your eyes open for things like abnormal volume and price action. A key indicator of a market top or peak is when the indices show stalling action, or rising with increasing volume but with significantly smaller price gains than before. This phenomenon is known as heavy volume without further price progress up. This signals that funds and institutions are beginning to sell off their holdings in large quantities, known as distribution as we mentioned prior. Typically, this selling occurs over 3 to 5 days within a 4 to 5 week period, often resulting in a market downturn. If you miss distribution signals like market tops, you might not be judging the direction of the market correctly. I mentioned this in a previous video, but I think it's super important to mention this again. A simple rule to protect yourself is to sell stocks if they fall 7 to 8% below your purchase price, which can help you to become more cautious as the market begins to correct. And it typically only takes one index showing repeated signs of distribution to signal a potential market top. The behavior of leading stocks also provide important clues about the market's direction. William O'Neill tells us that when these stocks start to exhibit abnormal patterns, such as breaking out from faulty base formations, it suggests that the market is headed for trouble. And these formations that he discusses are characterized by wide, loose, and erratic price movements. A climax top, where a leading stock experiences a sharp, rapid rise over 2 to 3 weeks after a long-term advance, is another warning sign. Additionally, if leading stocks experience significant price drops on heavy volume but fail to recover meaningfully, or if their quarterly earnings reports show a loss of momentum, these are further indicators of a potential market peak. These are just some formations that I wanted to cover super briefly. If we take a look at this chart of Sofi Technologies, we can see an example of a climax top. William O'Neill said that in this formation, you would see a move of 25% or higher on high volume within 2 to 3 weeks. And we see an approximate move of 25% with a gap up being there as well within 8 days. And what led this to be an exhaustion gap though is the fact that the basing period that it occurred after was erratic and super choppy and not moving in a tight range. And the price moving with the market during early August fell significantly to almost 20% and is still not recovered fully above the 100-day moving average that's shown on the screen. Now, if you watch the leader versus laggard video, you know that the innovative potential and quality of a stock is so important. When lower quality laggard stocks in an industry begin to dominate the market activity, especially during up days, it often signals that the bull market is nearing its end. Weak leadership cannot control the market, and when it attempts to, rest assured it will be short-lived. This is because strong markets are typically led by high-quality leaders, as we've said so many times in the past. Continuing with bear market signals, market tops often occur several months after the last major buy point in leading stocks, making them late signals of an impending downturn. During this period, some leading stocks might still appear strong, so watch out for that. This strength is pretty much temporary though, as even the strongest stocks eventually succumb to broader market pressures. And after a market top, the first rally attempt often fails. Signs of a weak rally include lower trading volume, minimal price gains, and the market recovering less than half of its initial drop. These signs indicate that further selling is advisable. And if the rally is legitimate, it typically follows through with a significant gain on higher volume within the 4th to 7th day of the attempted rally. Oh yeah, and before moving into looking at the state of the market, there's one last thing that I want to cover. And it's essential to avoid re-entering the market too soon after recognizing a bear market. Bear markets often have multiple phases with brief rallies that can deceive investors into buying prematurely. It's better to stay on the sidelines until a new bull market is confirmed, which is usually indicated by a strong follow-through day on higher volume, signaling the start of a genuine recovery. William O'Neill mentions follow-through days quite a bit, and simply put, it occurs when a major index like the Nasdaq rises significantly on higher volume than the previous day, typically between the 4th day or 7th day of a market rally attempt. I actually have an example of a follow-through day that was just 4 to 5 days ago. Though we're not in a bear market, there was a significant downturn that occurred in the market during late July into early August. The Nasdaq saw a huge drop for 3 consecutive days with a 3.4% decline on the last day. That candlestick even had lows that pushed below the 200-day moving average. However, the next trading day saw a reversal to the upside with a close higher than the previous day. This was the start of an attempted rally. On day 6, the follow-through day occurred where the Nasdaq pushed up 2.43%. The days that followed had higher lows that remained above the 20-day moving average, and the most recent day just crossed the 50-day moving average, which is yet another potential buy signal. So, recognizing and waiting for a successful follow-through day as such can be the key to catching the start of a sustainable bull market leg rather than falling for a false rally. Let's look at the market direction right now. Just over a week ago, on Monday, August 5th, worries about the state of the economy were shown to prevail in the market with heavy selling. The effects of the yen carry trade situation was a huge factor, alongside the jobs report from the previous Friday showing unemployment increasing from 4.1% to 4.3%. In addition, the economy added a lower than expected 114,000 non-farm payrolls in July, and stocks just sank overall. This continued into Mondays with fear of economic slowdown or potential recession. The S&P fell 3%, the Dow fell 2.6%, and the Nasdaq fell 3.3%. However, since then, the market seems to be extremely resilient, with the S&P showing its performance being the best since October of 2023, steeply upwards for 7 consecutive days. In addition, the tech sector is showing its best performance, showing the best week since almost 2 years prior in November of 2022. For the short term, I'm actually pretty bullish about the market, especially in the midst of the follow-through day and the great sentiment around the state of the consumer, with retail sales going up. However, the market also may possibly move horizontally going into the next week, considering that we may be approaching the stage of being overbought. That's all I have for today. Before we end off this episode, I highly recommend that all of you watching make the decision to read William O'Neill's How to Make Money in Stocks, which goes in depth into CANSLIM with hundreds of examples of the characteristics of market winners. This is purely a suggestion, and I'm not affiliated with IBD. Thank you so much for watching this video. CANSLIM is now officially over, and I have all the videos that I made in a playlist, and I put it down in the description so you guys can always go back and get a refresher. I hope to see you guys in the next video where we're moving on to new things like charting patterns and stuff of that sort. See you soon.